Hello and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. The Reserve Bank is currently making a lot of headlines, a record official cash rate increase of 75 basis points, forecasts of more to come, and acknowledgement from Governor Adrian Orr that the central bank is deliberately engineering a recession. To discuss all this, I'm joined by Karen Silk. She's the Reserve Bank Assistant Governor and General Manager of Economics, Financial Markets and Banking. Karen is also a member of the Reserve Bank's Monetary Policy Committee, which is responsible for making monetary policy. Hi Karen, and welcome to the Of Interest podcast. It's great to have you with us.
Hi, thank you. Pleasure to be here.
So you'll be well aware, of course, that the Reserve Bank has been coming in for a fair bit of criticism in recent months. One of the key criticisms heightened by the latest monetary policy statement is that the Reserve Bank overcooked stimulus in 2020 and 2021 by keeping the OCR too low for too long, through the billions of dollars of government bond purchases under the large-scale asset purchase program and removing restrictions on banks' high loan-to-value ratio home lending. And having done that, the Reserve Bank is now, according to some people, deliberately steering the country into a recession to make up for overstimulating the economy in the first place. Just wondering, how do you respond to that argument?
The first thing I'd say is we've obviously just released in the last couple of weeks a review of monetary policy formulation and implementation over the last 5 years. And, we outlined in that review both learnings from that period. And in terms of doing that review, looked at both monetary policy formulation in real time, so what were the conditions that were being experienced at that point in time, and then in hindsight, what have we learned from that? And certainly the review highlights that at the time alternative monetary policy tools were being implemented. They were being done in order to resolve both market dysfunction at that point in time and at a time when the OCR couldn't be taken any lower. And so the LSAP program, as you have rightly said, was introduced. And then secondly, on a forward-look basis, what were the conditions that the market was forecast to experience? So rising unemployment, dramatic slowing of growth, were some of the key things, and low inflation. So at the time, that was the forecast, and it was a forecast that was widely shared across most forecasters within the economy. But as I say, lessons learned from that was that monetary stimulus was in place for longer than required, as a consequence of, we've learned that government subsidies can be more effective than they were originally anticipated. Yes, there was more stimulus at that point in time. So the Reserve Bank and the Monetary Policy Committee started to indicate that tightening would be occurring, from early 2021, around April 21, and then obviously started to stopped the LSAP program in July 21, and then moved into lifting the OCR in October 21, and was one of the first central banks to do so, recognising that inflation at that point in time was less transitory than first anticipated. And so since then, we've increased interest rates by over 400 basis points since then. And recognising the increasing inflation that was being experienced within the economy, but also more globally. And so, and that the global inflation in part is a recognition of some of the shocks that have occurred post the monetary policy starting to increase interest rates, and in particular, I'd call out the war in Ukraine, obviously, and the impact that that's had on both oil and food prices.
Speaking to Parliament's Finance and Expenditure Select Committee last week, Adrian Orr said we are deliberately trying to slow aggregate spending in the economy. The quicker inflation expectations come down, the less work we need to do and the less likely it is that we have a prolonged period of low or negative growth. Just wondering if you could tell us, from what does slowing aggregate spending in the economy mean to the average person?
Yeah, so what Adrian's talking about there is that domestic inflationary pressures have obviously continued to intensify over the past 6 to 12 months and actually be more persistent. And that's reflecting resilient demand, as he highlighted in the economy. So what we've seen there is not only the lag data, so CPI, inflation, and actual retail spending continue to move higher. We're seeing higher frequency spend data, so household spending continuing to strengthen as well, and likely to remain really through till the end of the year at the very least. And so electronic data, card transaction data was up in October, retail spending was up in October, and quite widespread. So for the first time in about 4 or 5 months, it included increased spending on durables, so vehicles in particular. In this case, all the credit card survey data is showing that card billings were up as well, and more spending happening across the services side of the industry, so retail trade, wholesale trade, hospitality. So we're seeing more spend happen in this economy.
Okay. And he also referred to inflation expectations there. Why do inflation expectations matter so much? I mean, I wonder, don't people's inflation expectations start rising once they're actually already experiencing inflation, in which case it's at best a lagging indicator?
So consumer expectations tend to, general consensus is they tend to reflect it, at least in part, experienced inflation. But inflation forecasts also we take into account what businesses are seeing, and so that intention for businesses to pass on increasing costs that they may be experiencing as well. So again, business inflation forecasts are incredibly important to understand.
In the monetary policy statement, it noted that you considered an even bigger OCR increase of 100 basis points. How close were you to actually going for 100 basis points?
Look, it was in the record of the meeting, I think we're quite clear around the discussion that was had. We actually talked about a wide range, so between 50, 75 and 100 basis points. The reflection going higher than 75 really reflected the persistence of demand that we're seeing in the economy and the inflation, tightness of the labour market. The difference between going from 75 to 100 really, in large part, reflects the discussion we've had and continue to have around the lag we see in the terms of passing through of interest rates into the economy. So the average rate on mortgages at banks, with banks at the moment, is still sitting at around 4%. And that really reflects that New Zealanders tend to borrow on a fixed rate basis, kind of taking that 1 and 2 year term as always being the favourite. And so it takes time for those interest rates to pass through. We've built that into the forecast, the continuing migration onto higher rates, but it is part of the story around how far we went.
How closely does the Reserve Bank look at core inflation when, I guess, the volatile food and energy costs are removed? And is this looking any better than the Consumer's Price Index, which has, of course, come in at 7.2 and 7.3% in the past 2 quarters?
Yeah, so we obviously look at core inflation very closely, and that's the thing that is of most concern really to us. So whilst CPI, you're right, is headline inflation, what core inflation will tell us is whether there's a persistence in the domestic economy of inflation, and that is high as well outside of the band and has been continuing to rise. There are various measures around that, but all measures are really reflecting a level which is above 5%.
Now, the Reserve Bank's monetary policy remit has dual objectives, of course, of inflation targeting and supporting maximum sustainable employment. In the latest monetary policy statement, you note that employment is beyond its maximum sustainable level, and you also note that employment was at a maximum sustainable level or under it in the December quarter of 2019. I'm just wondering what has to happen for employment to get back below a maximum sustainable level?
Yeah, so really, again, it's about getting demand and supply into equilibrium in the economy. And, there are supply constraints in the economy. Labour market is one of those constraints that we are facing into. We're in, at near or record levels of constraint in that part of the market. And so our focus is really on how do we reduce demand to get to those kind of levels. As you rightly point out, we target inflation. Our objective or our mandate is to support maximum sustainable inflation, but we to get the important piece for us in order to be able to support employment to be at that maximum sustainable level, what's really important is price stability in an economy. And reducing inflation is all about ensuring that over the longer term we do have price stability. Our target obviously within that 1 to 3 band, and that's the best thing that we can do in order to ensure that businesses and individuals have the confidence to invest in this economy in order to support it and allow it to grow and allow for employment to therefore match the level of demand within the economy.
So the wage increases obviously that people have been getting and the labour shortages are contributing to the strong inflation that we are experiencing at the moment. Do you obviously want those to be, well, you'd like to see the labour shortages, I guess, reduce and maybe some of that wage inflation that some workers are enjoying also reduce. But what about in terms of the actual unemployment number? I mean, we're at 3.3% now. December 2019 was 4.1%. That's 97,000 people, according to the last stats NZ data, unemployed. Do you actually need more people to lose their jobs for you to see this this labour market come back to what you consider to be at maximum sustainable level?
Yeah, so look, what we're forecasting is a slowing in the economy, which will reduce the demand for the number of workers within the economy. So what needs to be recognised is that, we are coming off incredibly tight, coming out of incredibly tight labour conditions, but also an economy that has been in pretty good shape. So terms of trade, level of performance, business performance has been strong in this economy. Employment, as I say, employment numbers, employment growth will slow. We're likely to go to a level below maximum sustainable employment in order to be able to get inflation back down. But it'll be a combination of not just a smaller number of jobs, but also a larger pool of workers. So our forecasts build in more people entering into the workforce, so they become working age, and also a small positive net migration by the end of, or positive immigration, I should say, by the end of the forecast period. So we're talking about somewhere around 15 to 20,000 coming into the economy. So you've got the pool of workers increasing as well as a slowing in employment growth. And you just have to remember that employment growth is incredibly strong as it stands today in this economy. And we saw that in the last set of data that came out, where we had a rising in employment and a rising in the participation levels. within this economy, and we're well north of other countries globally on that.
So far, since the OCR increase last week, at Interest.co, we obviously monitor bank, mortgage and deposit rates closely, and we've noted very little action from banks since last Wednesday in terms of either mortgage rate increases or deposit rate increases. Just wondering if this is a surprise to the Reserve Bank at this point, and could this lack of mortgage increases in particular undermine what the Reserve Bank's trying to achieve here? I mean, I note that you did point out earlier that a lot of people, or the average mortgage rate's still around 4%, and banks' 2-year average rate now is around 7%. So that lag, as people refix, is still filtering through. But if banks don't pass this on, is that a problem for you?
So there's a couple of things there. The market wholesale rates had already substantially moved ahead of the monetary policy statement last week. So we had seen a significant movement upwards in interest rates between the August MPS and the last MPS. So there'd been, substantive portion of the movement we would have expected had already occurred. So the OCR was playing catch up in that sense. Along with that movement upward, the banks had already moved mortgage rates up as well, and had moved out of the 5s and well into the 6s in terms of those mortgage rates. So we had seen quite a substantive movement already. The other thing I'd just note is that banks tend to just sit back and absorb, first of all, what's happened under a monetary policy statement, and so it normally takes a week or two before you see any further movement in relation to that.
I also just want to ask about the funding for lending program. So obviously this is the program through which the Reserve Bank offers banks 3-year loans at the OCR rate. I'm just wondering, to what extent is this a factor in perhaps them not necessarily passing on all those mortgage rate increases through to their borrowers? And will the end of the funding for lending program, which is imminent, next week indeed, change things? And obviously banks have borrowed, I think, at $18.7 billion through this program to date.
Yeah. So you're right, the funding for lending program does finish next week. It provides funding to the banks at the official cash rate. So as the official cash rate is increasing, so does the cost to the banks. Compared to wholesale markets, it is comparatively cheaper, but it represents less than 2% of total bank funding. So it's at a very marginal level, still providing some stimulus and holding rates back a little bit, and we take that into account when we're setting the OCR levels. Our estimate is that it is adding roughly 5 basis points to the OCR track. If I stand back and look at total bank funding, so their debt funding, roughly 70% of total bank debt funding is in the form of deposits. And the comment that we were making last week around whether financial conditions were contractionary enough in terms of retail is a reflection that banks have a substantial level of funding available to them today in a low credit growth environment through the form of term deposits, and the mix of those term deposits has been more heavily weighted to lower interest-bearing transactional accounts than historically. So we're only just starting to see the migration across from transactional accounts into term deposits, and that is gradually, we're starting to see that migration happen. Now, in our forecast, we are anticipating that we will continue to see that movement and that the bank's funding costs will start to increase as the level of term deposits versus transactional increases. So that's a bigger driver.
Last week's monetary policy review was the final one scheduled for this year. In fact, the final one scheduled for 3 months, with the next one due on February the 22nd next year. Just wondering, from a monetary policy perspective, what are the key things the Reserve Bank will be watching between now and February 22nd? And what would help moderate your current hawkish outlook?
Yeah. So obviously there's a swathe of data that comes out between now and the February MPS. So we will see GDP, CPI, all the labour and wage data will come through. Most of that is lagged data, so it is reflective of conditions that we are experiencing today. So one of the critical things for us is we will be focusing much more on what I call the higher frequency data. So, which is something that we do take into it, well, we do focus quite heavily on now, and that does come back to understanding what electronic card transaction data is telling us, retail spending itself. So what are we seeing in terms of the level of expenditure? Is that continuing to increase? The mix of spending that we're seeing. So are we seeing less spending on durables and white goods? Those things that are much more interest rate sensitive. We'll look at things like the credit card survey data. We'll look at both manufacturing and services data as well. And obviously the other thing we do is our engagement with businesses and understanding how they're feeling about price, what they're seeing from a input cost perspective and their pricing intentions. So it's that real high frequency stuff that will be a very big focus for us. We need to start seeing a slow down in the level of household spending. We're already starting to see some pullback in residential investment, obviously with house prices down. Construction pipelines still look pretty good. Consents for new housing are still, on a monthly basis at record levels, so we'll be watching that closely. But we'd also note that banks are telling us that the level of construction companies are telling us that the level of pre-sales have declined dramatically. So we would expect to see that sector start to pull back again in the second half of next year as well.
Now, I noted that the next scheduled monetary policy review is February the 22nd. There have been a couple of instances in the past where there have been unscheduled monetary policy reviews, and I note, post September 11, 2001, and I think I recall one during the global financial crisis in 2008 as well. Obviously, these were big international events where the RBNZ deemed action was required, and in both those cases there were cuts to the OCR. I'm just wondering, what might it take over the next 3 months for such an unscheduled monetary policy review? And I mean, just as an example, and I'm not saying this is something that would make you change the OCR, but right now, China's very much in the news with some fairly widespread protests sparked by COVID-19 restrictions. So I guess you'll be watching overseas events too.
Yeah, obviously, we do look at things quite closely. We have a scheduled calendar of meetings, which certainly helps the market in terms of being prepared and understanding when we will be making announcements. We do not anticipate having to hold another monetary policy meeting between now and February. But as you quite rightly pointed out, we have the ability to call one whenever is required. I would have to say that for us to do something like that between now and February, it would have to be some kind of shock event that would cause that to happen. Let's all hope we're not in that position.
Indeed, I think we can certainly agree on that. Well, look, thanks, Karen. That's Karen Silk, Reserve Bank Assistant Governor and General Manager of Economics, Financial Markets and Banking, and Karen's also a member of the Reserve Bank's Monetary Policy Committee. And I'm Gareth Vaughan from interest.co.nz with another episode of our Of Interest podcast.